The Ukraine war, inflation, and investing your money right now. Must-dos at every age. That's what we're talking about today. Because what a 20, 30, or 40-year-old might consider doing with their money and their investments right now differs a fair bit from what a 50 or 60-year-old might consider doing with theirs, or anyone who's thinking of retiring soon for that matter. By the end of this video, you'll know what these differences are for your age group, plus how we're thinking about investing our own money at the moment. As devastating as war is, you should be way more worried about high inflation than war when it comes to your money and investments, at least in my opinion, and I'll show you why in a quick moment. If you want to skip ahead to the relevant section for your age group, timestamps are below. Our stock market is resilient over the long haul. If you look at the 6 biggest wars over the past century and the S&P 500's average annual performance 10, 15, and 20 years after the US's point of entry into each war, you'll see that the S&P 500 has gone up every time. This happened with the Iraq War in 2003, the Gulf War in 1990, the Vietnam War in 1965, the Korean War, and World Wars I and II. And yes, the Vietnam War is highlighted in yellow for a reason. And as a hint, these returns are not adjusted for inflation. Let's talk war and money first. War, inflation, and money are coming up in about a minute. As we always say in the industry, past performance is not indicative of future returns. But history is all that we have to work with when it comes to war, inflation, and your money. And what history shows us, as the author of this recent Bloomberg article sums up so well, is that wars don't have a record of creating lasting losses in markets. Even after the bombing of Pearl Harbor, which led us into World War II and resulted in the S&P 500's steepest war-driven decline of nearly 20%, it took the market less than a year to recover. Now, in any given year, and especially during wartime years, there is a lot of volatility in the market. But as you can see from this historical growth chart of the S&P 500 over time, the general direction is up, despite some blips and sideways moves along the way. Here's what $100 invested into the S&P 500 would have grown to 10 years later, 15 years later, and 20 years later, assuming you started investing in the year that the US entered each war. And this even with the Great Depression. So war will not impact the long-term growth of your money in the stock market, assuming you are invested long-term and you are invested in the S&P 500 or something similar. Because long-term sustainable growth, that's what our main focus is here at Diamond NestEgg. Now, war and inflation. What happens when you combine the two? So, if I were in my 20s, 30s, or 40s right now, here's what I would seriously think about doing. Actually, I am in one of those age groups, by the way, and this is actually what I'm doing. 1, I keep dollar cost averaging my investments, especially anything that's earmarked for retirement. 2, I look for ways to inflation-proof my extra cash. And 3, I check my emergency fund regularly to make sure that it's still enough to cover me given how high inflation is right now. Inflation. And when I say inflation, I mean high inflation, like what we have now, like what we had the 10, 15, and 20 years after the Vietnam War. High inflation will have an impact on the long-term growth of your money in the stock market. Here's what the non-inflation adjusted average annual rate of returns were for the S&P 500, 10, 15, and 20 years after the Vietnam War. So when you only consider the war factor. And here's what the numbers look like when you consider both war and inflation factors. These are adjusted for inflation. Pretty bad, huh? And that's what I mean when I say you should be more worried about inflation than war when it comes to the long-term growth of your money, your investments. Yes, the circumstances of Vietnam are different from Ukraine. We're not actually in the Ukrainian-Russian war like we were in Vietnam, yet. And we may never enter the Ukrainian-Russian war. Who knows? Having said that, the Vietnam War plus the high inflationary period of the 70s bears the most resemblance to the situation we're currently in now when it comes to war, inflation, and your money. And this one hits very close to home. My parents fled Vietnam with me not long after the Americans left, and Saigon fell to the communist North Vietnamese. Lucky for us, we ended up in America because during the Vietnam War, my dad had fought alongside the Americans as an ethnic Chinese. But we landed in New York in 1979, right as inflation was about to peak here. Ironic, huh? But hey, we're here, we're fine, and I digress. So Vietnam and Ukraine, not the same war-wise, but similar enough. And the same goes for inflation in the 1970s versus inflation now. Very, very similar situations. Inflation in the 1970s was driven by massive government spending, massive budget deficits, and massive social programs. Lyndon B. Johnson's Great Society, and a war in the background. Inflation today, right now, is driven by massive government spending, massive budget deficits, and massive social programs. Think about all that so-called free stimulus money, and a war in the background. But none of that really matters if you're in your 20s, 30s, and 40s. Why? Because the annual S&P returns start looking much better if you take the Vietnam War and the inflationary period of the 1970s out by another 5 to 10 years. Take it out to 25 years after the US's point of entry into Vietnam, and you see that the average annual return of your S&P investments starts ticking upwards again to more normal levels. And the same can be said if you take it out to 30 years after the US's point of entry into Vietnam. So, as someone in this 20s, 30s, and 40s group, I'm staying the course. Our investment strategy was sound before. It will be sound after the noise and uncertainty died down as well. We'll keep dollar cost averaging, keep stashing away cash for retirement and whatever else. No massive changes in our portfolio. The one thing that we have done, though, is to reassess our emergency savings. How much do we really need this year? And how much is just extra, nice to have? And for the extra, the nice to have cash that we don't need for the next 12 months, check out this video here. It's what we've done to inflation-proof some of it. Ibonds are 30-year term inflation-linked government savings bonds. So as safe as it gets. They're yielding 7.12% right now. And given the 7.9% inflation number that was released for last month, it's looking like the 7.12% IBON yield will be going up at the next IBON adjustment period in May. So make sure you check out our IBON video tutorial for step-by-step buy instructions and other details, concerns, and restrictions. I've linked the video in the description below as well. As I always say though, everyone's financial journey is different. I don't know your specific situation, so if you're interested in seeing whether we can help you, drop me a note at jennifer@diamondnestegg.com. So, if you're in your 50s and 60s and looking at these inflation-adjusted post-Vietnam War S&P numbers, you're probably thinking to yourself, I don't have time to wait for the market to recover over the long term. Is that really true though? Is it? I tell our clients this all the time. It's not about getting to retirement, it's about getting through retirement. These days, on average, men live until they're 78 and women until they're 82. If you're just in your 50s, you still have a solid 20, 30 years ahead of you. And here's a quick story. One 80-plus-year-old client of ours told me a month after COVID shut the world down, so mid-April 2020, that he was selling all his Apple shares. I asked him why, and his answer was,
"The market's crashing. Do you know how much I've lost already? What if it gets worse?"
And my answer, what if it gets better? You have enough to get through at least another 18 plus months. And Social Security. Here's where you can cut your expenses. Let's just say his Apple shares bounce back and then some. So if you're currently in your 50s and 60s or closing in on retirement, here are your top 5 inflation, war, and your money must-dos. Must-do number 1, do not panic. Stay rational and don't let your emotions get the best of you. Don't rush to sell your investments at a loss if you don't absolutely have to. As I said earlier to the 20s, 30s, and 40s age group, If your asset allocation was working for you before, it should still work for you now. So there's no need to take drastic measures. Must do number 2, fine-tune your excess cash. Now, this assumes you have excess cash. So let's go and figure out whether you do or not. Calculate how much cash you really need for the next 12 to 18 months. Think of this as your 12 to 18 month emergency fund. And given the general upward direction of prices, do build in a bit of a cash buffer. If it turns out that you do have excess cash above and beyond what you need for the next 12 to 18 months, then there are a few things you can consider. Ibonds, just like for the 20, 30, and 40-year-olds, these 30-year term government savings bonds, whose rate of return is tied to inflation, are already yielding 7.12% right now and are 100% backed by the US government. We just bought quite a bit ourselves with our excess cash. I've included the link to our How to Buy Ibonds tutorial below this video. Be sure to watch this beforehand so you fully understand the pros, cons, limits, and restrictions of buying and owning an Ibond and whether it may be right for you. Inflation-adjusted annuities. An annuity is a contract between you, the owner, and an insurance company, which provides you with income for a specific number of years, generally during retirement or in the most ideal situation for your entire life post-retirement, so you don't outlive your money. In the simplest terms, think of an annuity as a way of giving yourself a steady income in your later years when you're no longer getting a regular paycheck from work. An inflation-adjusted annuity is, you guessed it, an annuity whose regular payouts to you are tied to inflation. We've been doing a lot of work lately in this area, so if you want to learn more about annuities, either check out our annuity videos here or speed things up and drop me a note at jennifer@diamondnestegg.com to see how I can help customize an annuity to your needs. Long-term care insurance. So long-term care in America, it's expensive. And this chart shows you exactly how expensive. On average, it'll cost you between $50,000 and over $100,000 each year right now in today's dollars. Even before the current inflationary environment, healthcare costs have typically risen at 2 to 3 times the rate of inflation. So you can imagine what these numbers will look like when you retire. Plus, there's a 70% chance that you and there's a 70% chance that we'll need long-term care after we turn 65. And on average, we'll need it for about 3 years. That's according to the US Department of Health and Human Services. Scary stuff, I know. That's why long-term care insurance exists, to protect your retirement nest egg so that you don't have to pay for all these costs out of your own pocket, out of your own retirement savings. Long-term care insurance has really come a long way since its rather costly use it or lose it days. And the time to buy it is before you need it, because you'll most likely not qualify if you wait until you do need it to buy it. Take care of your health and your wealth. You know what to do if you're interested in learning more about customizing a long-term care insurance policy to your needs. Must do number 3, consider refinancing your existing debt. The Fed already raised rates last week, and this will likely continue given where inflation seems to be headed. If you're sitting on debt now that's due in the next 18 to 24 months, debt that you don't think you can pay off, and in particular if it's high interest debt or variable rate debt, like credit cards for example, consider refinancing this debt into a fixed rate loan sooner rather than later. Given where we stand with inflation right now, the only realistic direction for interest rates to go is up. Check out our inflation and debt video here if you want a bit of guidance on how to go about making your debt refinancing decision in the current environment. Must do number 4, find ways to make more money or spend less. 2 of our daughters have a 67-year-old music teacher. He teaches music as a side gig because that's what he enjoys doing. And he earns a nice sum each month doing this. The 80-plus-year-old client that I told you about earlier who didn't sell his Apple shares during the depths of COVID, he's in the middle of launching his own music brand on YouTube. I'm seriously not making this up. And our neighbors next door, also in their 60s, they sold their house a few months back for 6 times what they bought it for about 25 years ago. And they moved to a beautiful, albeit smaller house nearby. The maintenance and property taxes on the new house, significantly lower. You get the picture. I strongly believe that where there's a will, there's a way. And every little way that we can make more and spend less during these crazy uncertain times is a bit more that goes towards our nest egg. Must-do number 5, try to take Social Security as late as possible. The later you take Social Security, the more your monthly Social Security check will be. And those payments, there's a cost of living adjustment that's supposed to help you mitigate a bit of the inflationary impact. In fact, thanks to inflation, Social Security beneficiaries got their highest cost of living adjustment in decades earlier this year, 5.9%. I know, that's less than the rate of inflation, but hey, every little bit does help. Guys, I hope you enjoyed this video. As always, drop me a note if you're interested in seeing if we can work together to inflation-proof your finances and give your nest egg the boost it needs. And don't forget to hit that thumbs up and for more money saving, wealth building, and inflation videos. See you again next week.